poor tax planning. Now, that's huge too, and that is certainly on top of mind awareness for near-term retirees. They understand, I think, a pretty good awareness when they come into our client meeting rooms for the first time. They may not understand all of what they need to do to have better tax planning, that's for sure, but they certainly are. It's on their mind on how their retirement income is going to be taxed and how that is different than their employment income being taxed when they are working.
There is a knowledge and help desert out there when it comes to forward-looking tax planning. And here's why. If you take a look at what a lot of people do, they get TurboTax or some other online tax service or something, and they file their taxes and they think, I've taken care of taxes. All they've really done at that particular point in time is done a rear view mirror look back on what they did last year. It isn't preparing for what you're going to do into the future.
And even if they're working with a CPA, and obviously the CPA can do forward-looking planning, but if you're not asking them to, if you're just going to them in April and going, here's my stuff, please file my taxes for me, then that too is a rear view mirror, just response to what you have already done. It is not forward planning. And
the biggest expense for any retiree is likely going to be their tax bill. When you take a look at 12-15% of your money coming off of your retirement paycheck, you probably don't spend 12 or 15% of your money on any one other category.
Potentially healthcare, depending on your individual details, but otherwise that's it.
But it's a huge expenditure. And for you to not understand and know how to control your tax on that money is really critical. And when you stop and think about it, of all the retirement income sources, they're all taxed differently. In Arkansas, certain pensions are not taxed. In Arkansas, Social Security is not taxed.
Guys, this is not really a tax issue, but it could have created a tax issue for this particular client if he had not sought some advice. When you get into dealing with required minimum distributions, it's very important to understand how much you need to withdraw and what the tax consequences are on that. And not to get too much in the weeds, but he was using the factor as a percentage. So instead of basically withdrawing 4%, he was going to withdraw about 25%. I'm using kind of rounded numbers there. He was going to withdraw about 25% because that's how he understood the required minimum distribution rules. He came in, fortunately, and talked with us before that. But think about the difference that would have made on his taxes. He would have paid, 600%, on, instead of paying 100% of what he would have owed, he would have paid 6 times that much in taxes that year because he was going to take out 6 times as much as what was required on his distribution. It's important to have a financial coach go through this process with you.
Want more content like this delivered to your inbox weekly? Visit fastest4.com to learn more.